Okay, now we are moving into our final part in terms of IAS 37, which is an addition for your standard in terms of financial reporting. Okay, these are called as special situations. There are four, and these are highly tested in your exams. Okay, these can come as MCQs mostly or section B type of questions. Okay, so there is something called as onerous contracts. Okay, and there is something called as future operating losses. There is restructuring provisions, and there is something called as environmental provision. So there are four type of provisions that we need to learn in brief for us to tackle off these type of questions. Okay. So if y'all are comfortable, let me start off with onerous contracts. What do I mean by onerous contracts is these are loss-making contracts, right? Now y'all can ask me, what is the obligation or why does a business need to take over a loss-making contract? Right? Obviously, on no business, always they want profits. That is their sole intention. Why would a business go and conduct if that contract is under loss? That might be a doubt. The same doubt came in when I was also studying. Okay. Okay. So let me take your two examples. For an example, you all are leasing a building. Okay, leasing means you all are taking the building on rent, say for about 5 years, right? With the intention of your doing your business services. Okay. But unfortunately, what happened was your business did not go well, right? Your business did not go well. So there was no use of you all going and using that business. Okay. But what you all need to understand is you all have signed a 5 year contract. Whether I do my business or whether I pause my business, I will be paying you the rent, right? I will be incurring that rental expenditure regardless of whether I conduct my business operations or whether I do not conduct my business operations. Okay. So that is a contract where I will be signing and giving. Okay. Then obviously I'll need to understand there is an obligation. Okay. There is a probable obligation. Okay. Why? Because I have signed and given saying that whether I conduct my business or not, for the next 5 years, I will be giving you all the rental payment. So that is one of a loss making contract. Obviously, I know if I conduct my business, that business will be giving me profits. But since I'm not conducting, there is no profits at all. Another example I could give you all is you lease a gem mine, or you all can lease a coal mines. You all know, right? Mines. Normally, people would lease it for 99 years, 100 years. Okay, in Africa, uh, mm, what do you call it? There are some other separate countries. Okay. Now, what happened was, say that the gem market, overall, the entire gem market fell. Okay. And for the another 10 or 20 years, it's not going to recover at all. So, obviously, again, your gem extraction process, okay, the way of your extracting the gem and all would suddenly come into a halt, right? You will be pausing your operations. Then, even though in that particular case also that will be considered as a loss making contract. Why? Because you have signed and given them saying that whether I conduct my business in extracting gem or whether I do not conduct my business, I will be paying you all the annual lease. Okay. So that is why I call these as onerous contracts. Okay. These are loss making contracts. Okay. You all are into a legal or a constructive obligation here that whether you all conduct the business or whether you all do not conduct the business, you all need to pay an outflow of cash. Okay. You all can ask what would be the accounting. Okay. The accounting would be simple. You all need to recognize a provision, guys. You all need to recognize the provision. But how will you all determine the provision? It would be the lower of. You all continuing the contract or discontinuing the contract. Okay. In terms of onerous contract, you all need to recognize a provision, and that provision would be the lowest of you all continuing the contract, and number two, you all discontinuing the contract. Okay. Okay. Obviously, you all know when you all are planning on continuing the contract, there will not be any income. Okay. Everything will be an expense. Okay. This would be your annual rent. Okay. This is the rent that regardless of whether you conduct the business or not, you all need to pay. So this is the cost when you all continue the business. Okay. And if you all are discontinuing the contract, that means if you all are canceling the contract, then you all need to incur penalty charges. Why? Because you all had taken that business promising that you all will be using that building for 5 years. But since you all cancel the contract, you all need to pay a hefty amount of penalty. Okay. You all need to pay interest charges. You all need to pay lawyer fees. All of these are cost of you all discontinuing the contract. Okay. So the standard simply says, in terms of onerous contracts, you all can recognize the provision. It has to be the it has to be the lowest of y'all continuing the contract or discontinuing the contract. So in this particular instance, I would say that y'all discontinuing the contract would be the lowest amount. Okay. So therefore, this amount you all need to recognize as a provision. Okay. So let me write the double entry, debit P&L, and you all need to credit your provision. Okay, of how much? It was, I guess, 23. Okay, this is it in terms of your onerous contracts. Now let us look into our second situation, which is your future operating losses. Okay, you all need to understand that we will only recognize a liability or a provision if there's a present obligation, not future obligation. Okay. So in order to determine whether there is do I need to recognize a provision or a contingent liability, right? There needs to be a present obligation which has arose from your past transaction and event. Okay. Not from your future. Okay. Not from your future. If I'm having a present obligation today, that needs to be from a loss that occurred in my past, not in my future. Okay, that you all need to understand. So therefore, you all will not be recognizing any provision. Okay, you all can ask me why. You all can ask me why, because I also had this doubt. See, this loss is going to occur in my future, right? It's a future obligation. It is not present obligation, right? And obviously, I'll know I can avoid this loss by different ways. Number one is, rather than conducting my business, obviously, I know if I conduct my business only, I'll have operations. If I have operations only, I'll have incur loss. So if I do not conduct the operations, then obviously I don't need to pay. Or number two, I can implement some controlling mechanisms to reduce my loss or for me to avoid my loss. Then also, if that goes according to my plan, then obviously there would not be any future loss. If there is no future loss, there is no obligation to pay anyone, right? That is the reason why I'm telling y'all that no provision will be recognized in terms of your future operating losses. Okay, you all can pause and think, and you all will itself be able to come up with the idea of it. Okay, now we are moving into the third situation, which we all call it as restructuring provision. Okay, one of the best example is COVID-19. See, there are two type of restructuring. One we call it as positive restructuring. Number two we call it as negative restructuring. Now in IAS 37, we will be only focusing on the negative restructuring. Okay. Okay. So before that, let me give you all what is a positive restructuring. See, for an example, for the betterment of my company, I'll be restructuring my managers or the entire management. Right? Restructuring means I'll be changing the management by bringing in smart, skilled workforce and replacing them with the old ones. Right? You all know, right? There are some old people. Yes, their expertise is needed, but they slack. So I don't need slacking people working for my company. Right? So I'll be chasing them off. I'll be giving them uh, the compensation and I'll tell them to go home. That is a positive restructuring. Or number two, earlier I only had 5 branches. Now I'm shifting my branch to a different country, right, for a new opportunity. That is positive restructuring. Now, in terms of negative restructuring, when COVID-19 hit, right, take all the restaurant businesses where we like to eat, right? Most of them they shut down or they reduced their number of branches, right? They terminated their employees. Why? Because they could not give salary. Okay. So that is known as negative restructuring. Can you see here? And also there were some companies they were operating globally. They had to come out of those. Right? Why? Because they do not have enough money to conduct their business. Okay. That is called as negative restructuring. Okay. So now you all will be asking, what is my accounting method? Right? What is my accounting method? But before that, I'll tell you all there are some costs. There are some costs that you all will incur when you all are restructuring. Okay. Obviously, you all need to pay redundancy pay for employees. Why? Because you all are chasing them out of their rightful jobs. Right? There are some contracts. You all might be taking the buildings on rents. You all might be taking the office and equipment on rent. All of those will be cancelled, right? All of those will be cancelled. Then you all need to pay penalty charges. That is also one of the restructuring expenses. Okay. So in terms of accounting, a provision can be recognized, right? You all need to recognize a provision in terms of restructuring. Can you all see here? I've mentioned only if there are few conditions. Okay. If those two conditions are met, then you all can recognize a provision. And if those two conditions aren't met, you all cannot recognize a provision. Okay. And those conditions as follows. See, in during COVID time, most of the management, if they knew that they are going into a restructuring or downsizing their company, they would have a plan, right? That plan would include how many employees am I going to sack, how many branches am I going to close, uh, what, how am I going to cover the cost. All of those will be a formal plan, and this formal plan should be approved, right? This formal plan should be approved by the entire management within the company, right? Because tomorrow, if one manager comes and tells that I did not know that you all are planning a huge restructuring, and if that goes on, that would be a bad impact for your company. So number one condition is you all need to have a formal plan. And number two is this plan needs to be communicated to all the affected parties. It can be your employees, it can be your suppliers, it can be your landlords. All of them needs to be communicated through either a mail or either a legal notice. Okay. Then only you all can recognize a provision. Okay. Here see. On 14 June 2005, a decision was made by the board to close down a division. See, they were operating in Germany. Now they are planning on closing down the Germany branch because why? COVID-19 stuck. The decision was not communicated at the time to any of those affected. I all know, obviously, if we do not communicate, They will be coming in front of our doors and banging our doors and telling, why did y'all close down your company? You all have outstanding payments to pay for us. You all have outstanding orders that you all need to fulfill. Right? They will come and question us. Okay. And no other steps were taken to implement the decision by the year end at 30th June 2005. Now, no other steps indicates that y'all don't have plan. Right? Obviously, if y'all have plans only, y'all will be starting on implementing those plans one step by step. If y'all don't have a plan, then there's nothing to implement. Okay. The division was closed in September 2005. The question is quite simple, guys. The question is asking, do you all need to recognize a provision or not for the year end as at 30th June 2005? There is no obligation. Okay. There is no obligation. Why? You all did not communicate. You all did not create a formal plan. Right? There is no legal obligation or neither there is no constructive obligation. See, in my past, as if I would have shut down a company. No, right? This is because of COVID-19 that unimaginable instance occurred. That is the reason why I went and shut down my company. Right? So there is no obligation. Okay. Therefore, you all do not recognize any provision. Okay, now let us look at something which is quite important in terms of IAS 37. If IAS 37 is tested as an MCQ, this is one of the parts that it can be tested. Okay, environmental provision. Okay, so in terms of environmental provision, there are so many examples. It can be your oil rigs. You all know that you all extract oil in the middle of the sea. It can be gem mines, coal mines, and it can be factory, whether you are constructed in a rural area or town, any of that sort, right? Okay, now you all can ask me, these are future related costs. Do I need to create a provision? I would say yes, you all need to create a provision. Why? See, when you all are building oil rigs in the middle of the sea, it's going to contaminate the water. When you all are doing coal mines, you all are digging as much as possible, and because of that, it creates landslides. Because of you all creating factories, right? Carbon dioxide is your ozone layer is getting damaged. So all of these are affecting your environment, right? And in terms of these are affecting both your present as well as your future environment. Okay. So here see, I'm mentioning a provision needs to be created for these future costs. Yes, these are future costs. Okay. But we have a present obligation, right? It can be a contractual obligation or it's a legal obligation. Okay, why do I say that is, see, before me getting into the operations of extracting my oil from the seabed, before me starting the coal mine or gem mine, or before me producing goods and services in my factory, I will write a contract on the very first day saying that, don't worry, government, when I'm leaving this premises of my oil rig or of my mines or of my factory, I will make sure that I will clean it only and give. Right? Whatever I have damaged, I'll make sure I restore, I make sure I rectify it, and only I'll leave the premises. So it will create us a present obligation. Why? Because I have signed the contract. Because I signed a contract, there is a legal obligation, right? That is why you all need to create a provision. Okay. Just because these are future cost, don't think that there is no provision. You all have a provision. Why? Because you all will be signing it in your past when you all were starting off your operations. Okay, now I'll try to explain the environmental provision with the help of this particular question. Okay, so what I want you all to do is make sure you read this question at least once and then watch your recordings. Okay, what they want us to do is they want us to discuss whether there is a provision or not in terms of your cost of cleaning this site, and they want you all to create an extract. Okay, so jump into the question. Rosely is a company that carries out many different activities. It is proud of its reputation as a caring organization and has adopted many various ethical policies towards its employees and wider community which it operates. Okay, fine. As part of its annual financial statements, the company publishes details of its environmental policies, which include setting performance targets for activities such as recycling, controlling emissions of noxious substances, and limiting the use of non renewable resources. Now, I was very fast, I totally understand, but let me explain. See, Rosalie has created an image as well as they have positioned themselves to be an organization which is caring towards the environment. Why? They do recycling, they control carbon dioxide as well as they use non renewable resources. Okay, so they have positioned themselves to be a caring organization among the employees as well as the wider community, which is just right. Okay, so what the examiner wants to tell you all is this is a constructive obligation. They have constructed in the mind that they are a caring organization of the people who are working for them as well as the wider community. Okay, so this creates a constructive obligation, okay, which is a symptom of a provision. Okay, okay, I'm again reading on. The company has overseas operation that is involved in mining of precious metals. These activities cause significant damage to the environment, okay, including deforestation. Mining causes deforestation. Fine. The company incurred capital cost of 100 million in respect of the mine and is expected that the mine would be abandoned in 8 years' time. What does this mean is obviously to start up the mine, you all have an initial cost of 100 million and they're planning on using this mine for the next 8 years. Fine, totally agree. I'm changing my color again. Okay. The mine is situated in a country where there is no environmental legislation obliging companies to rectify environmental damage. Okay, so there is no legal obligation, right? In the country that they are situated or they are working for, it does not have any legal obligation. And it is very likely that any such legislation will be enacted within the next 8 years. That, of course, you all understand. It has been estimated that the cost of cleaning the site, that is, after 8 years, they're planning on cleaning, right? They're planning on leaving the business and cleaning the site and replanting the trees will be 25 million. So after 8 years, you will be having a cost of, after 8 years, you will be having a cost of 25 million to clean, right? This cost is after 8 years. Okay. If the replanting was successful at the first attempt, okay, now they are not sure whether this 25 million will be successful in its very first attempt or not. I'm again reading on, but it will be probably. Now you all need to understand we have learned this word probably be necessary to make further attempt, which will increase the cost by a further 5 million. Okay, so they are what they're trying to tell is in your initial first attempt, you all will incur a cost of 25 million to clean. But that is not enough. Okay, there is a probable future cost also to complete your restoration process, which is 5 million. Right? Now, since this is a probable cost, right? You all need to recognize this as well, this 5 million as well. Okay, so your total future cost would be 30 million, which is 25 million at your first attempt and your probable further additional cost. If they have told you all possible, then you all don't need to recognize that 5 million. Since it's a probable cost, that is the reason why I'm recognizing this. Okay, so our first step is to identify the future dismantling cost. Okay, we have identified it out to be 30 million. That is our very first step. Okay, now before moving into your second step, now you all need to understand we are preparing accounts for our current financial year. Okay, we are preparing accounts for the current financial year, and these costs are supposed to be incurred in another 8 years' time. They are not going to be get incurred in our current financial year. They are not going to get incurred in our next year. They are going to get incurred in another 8 years' time. Okay, and we are preparing our accounts only for our current year and not for 8 years. So we need to understand that this 8 years cost also needs to be included within our current year financial records. So what do we do? What do we do? We need to take the present value of this 8 year time cost that we are supposed to, or that we are going to incur in 8 years time. We need to find out the present value of the future dismantling cost. Okay, if we do not record this and if we wait until, okay, let the 8 year come and let me recognize it, then I'm planning on misleading my shareholders. Why? Because then shareholders will start to panic. Why didn't you tell me before? Why wasn't I informed prior? They would be asking. Okay, so now your step two is to find out the present value of the future dismantling cost of 30 million. Okay, again, again, we know that this is a future cash flow which is going to occur in the 8th year. I need to find out the present value. Now, you all know how to find out the present value. Your future cash flow into the discounting factor will give you all the current present value of your future cost. Okay, I put it in the brackets because it's a cost, it's in the minus form. Okay, they have given us the cost of capital as 10%. They have given us the cost of capital as 10%. Here it is. Okay, so obviously this is the 8 year cost. So 1 divided by 1.1. 1.1 is 1 divided by 10% to the power of 8 years. Okay, we'll be giving you all a current present value of 13.99 million outflow. Right? So this is the value as of today for your future 30 million cost. Right? Or in simple terms, your 30 million future cost is equivalent at today at 13.99 million. Okay. Okay. Now always remember we will only take the pre-tax rate. Okay, maybe I'll be calculating discounting factor in terms of environmental provision. We will only take the pre-tax rate. Again, I'm highlighting pre-tax rates. Okay. Okay. Now, this 13.99 million, we will create a provision. So it is a credit entry of 13.99 million. It's a credit entry. Okay. This is your credit entry. And where will you go and debit it? This will be debited under your assets. Okay. Now this, we have learned it under IAS 16. Under the initial cost recognition of an asset, you all can recognize future dismantling cost. We have learned this under IAS 16. Okay. So debit property, plant and equipment by 13.99 million and credit your provision for future cost by 13.99 million. Okay. If you all don't remember, please go and revise. Please go and revise your IAS 16 standard. Okay. So since this is an initial cost, you all can add this to your assets value under the initial recognition of asset. Okay. So the cost was 100 million plus your future dismantling cost at present is valued at 13.99. So your total assets value would be 113.99. Okay. So until here, we are done with two steps. One step is identifying your future cost. Your second step is identifying the present value of your future cost. Right? After that, that future cost will be added to your initial assets recognition cost. Okay. So until here, I hope you all are clear. Pause your recordings at this particular point if you all are not clear. Okay. Now, We know the cost of the asset, right? We know the cost of the asset, so obviously we need to do depreciation, right? And the cost is now 113.99 million for 8 years, right? 113.99 consists of your 100 million initial cost as well as your future dismantling cost. Okay, that is how I came at 113.99. Okay, so you all will be getting a depreciation of 14.24 million per year. Okay, this part is of course easy. You all can handle this. Okay, you all can handle this. The only part where you all be struggling is in terms of recognizing this part. Some people tend to forget. Don't forget this at any point. Okay, depreciation you all will be able to manage. Now we are moving into the third and final step. Okay, third and final step is something called as unwinding the discounting. We call it as unwinding the discounting. Now this term is totally new. Don't worry, let me explain it. Okay. Now look at this. This 13.99 million is there, right? This is for your first year, right? This is your present value for the first year, right? You all need to increase this provision until 8 years. The reason why I'm unwinding or the reason why am I increasing my provision is at the 8th year, when I'm coming to my final 8th year and when I'm preparing my account should be equal to 30 million, right? My account should be equal to 30 million at my final 8th year, right? That is the sole reason why I'm doing unwinding of my interest. Okay, let me prove it to you all as well. Let me prove it to you as well. Look at this. For my very first year, I will be charging an interest of 10% on my first year provision, which is 13.99. I'll be charging an interest of 10%, right? So my interest would be debit financial cost. Always remember, you all need to do this. This is a compulsory part, right? Until your 8th year, you all need to do this unwinding of your discount. Okay. So first year, you all will be getting a financial cost of 1.4 million. Okay. So debit your financial cost and you all need to increase your provision by 1.4. Yes, see. Now, why do I'm telling you all, why am I doing this unwinding is at the end of my 8th year, at the end of my 8th year, in my financial position, it will be equivalent to 30 million. Now, this is because of the rounding off issues, but at the end of the 8th year, it will be equivalent to 30 million. This is at my 8 years financial statement, right? Which I'll be preparing after 8 years, right? Until that, what I will be doing is I will be increasing my provision. Can you see here? Each year I will be charging interest. For the 8 years, interest will be calculated and I will be increasing my provision until I end up at 30 million. Okay. So what I want y'all to do is, guys, since this is your very first time of learning environmental provision, I want y'all to pause this recording in terms of environmental provision and watch it in a slow pace manner. The rest y'all can watch it in +2 speed. No worries. Okay. The only part y'all will be getting confused or y'all will be misled is when y'all are calculating the present value of a future cost. And number two, the new thing which I call as unwinding of discount. Okay, again, understand, I only do unwinding of discount is for me to reflect this 30 million in my 8 years financial statement, which I will be preparing in another 8 years time. Until that, I will be hitting my financial cost each and every year. Why am I hitting my financial cost? Because for me to increase my provision. By me increasing my provision each and every year until my 8th year, right? From my first year, second year, third year, fourth year, fifth year, sixth year, seventh year, 8th year. For the 8 years, I'll be increasing my provision by hitting my financial cost as an expense for me to arrive at 30 million future cost. Okay. I want you all to try this and see, and then directly move into Kaplan or BPP or Study Hub related environmental provision question, which I'll be uploading in a very next video, and you all can identify whether you all have understood this completely. Okay. Okay. In terms of, okay, I thought we would finish. Okay. In terms of extract, obviously you know your statement of financial position of your current year. Okay, cost, accumulated depreciation, carrying value, or net book value. Your initial cost is 113.99 million. You all will be charging depreciation of 14.24, and you all will be arriving at a net book value of 99.75. This is manageable. Okay, only part is you all be getting stuck in terms of your future dismantling cost. Right? Why? Because you all need to include it under your cost. Okay. Now, under your non-current liability, you all need to recognize provision. Why? Because it's a payable. It's a payable. Now, under non-current liability, why I'm including non-current liability? Each and every year, you all be recognizing it. Okay, how much will you be recognizing? 13.99, which is your initial, as well as your each year's increase in finance expense. Right? So 13.99 million plus your each year increase, which is 1.4 million for your first year. You see, your first year, you will be increasing it by 1.4 million, right? Your second year, you will be increasing your interest or your provision by 1.5. Third year is 1.6. Fourth year, you will be increasing it by 1.86, right? This will happen until your final 8th year. Okay, but we are supposed to only show the extract for our very first year. So this is an extract of your year 1. Okay, and in terms of your profit or loss, we know each year you will be expensing finance cost, right? So finance cost is an outflow. So for our very first year, we'll be showing an outflow of 1.4 million, right? As well as we have a depreciation of 14.24. Okay, so this is it in terms of extract. Say if you're preparing year 2, you will be showing an interest cost under your profit or loss as 1.5. You will be showing the relevant depreciation, as well as your net book value will be revised. Also, in terms of provision, you will be showing this amount, year 2, 16.9279. Okay, try doing this alone and you all will be able to understand. If you all don't understand, please feel free to WhatsApp me.